Welcome to Buy, Hold, Sell, brought to you by Livewire Markets. My name is Vishal Tekshanani. In 2025, while broader markets had a fantastic run, the lion's share of profit went to investors willing to back big themes. The question now is, do these themes still have legs in 2026? Joining me to assess 6 key pockets of opportunity are Michael Wayne from Medallion Financial and Adam Dawes from Shaw & Partners. Welcome, gents. We're going to talk about these themes, and they're also going to name their one best investment idea and the ETF to play in 2026. So Adam, I'll kick off with you. Uranium, up 18% this year.
Yes.
Up 22% per annum in the last 3 years. Buy, hold, sell.
Doesn't feel like it's been up 22% per annum, but anyway, yeah. Look, it's a buy. I think uranium is certainly an energy that is going to be needed. Is seen to be green or at least be less polluting, and I think certainly a lot of businesses are looking for SMRs, which are small medium reactors, to power their needs, especially for data centers and those kinds of things. And if you're going to ask me for an ETF, in there are URNM. It's a BetaShares one, and it has all of the global uranium miners in there, and it's a great way to diversify and get access to the uranium market.
Okay, feeling the same way about uranium?
Yeah, absolutely. Doesn't feel like it's performed that well because I don't think the underlying uranium stocks have done that well. But yeah, to all the points that Adam made, there's a lot of approved, proposed reactors globally that have been, built or in the pipeline to being built. In Australia, that isn't so much the case, but certainly globally there seems to be enormous tailwinds, and there's a big lag in the amount of supply coming online. So a buy on uranium. The stock that I would put forward, or an individual stock, is NexGen, the Canadian-based explorer. They've got a very large resource, which is yet to be developed and put into production. However, if they can get that thing into production, it's going to have extremely low costs relative to the competitors and could be a sensational investment. So buy on uranium and NexGen as an individual name.
Okay, bullish on uranium. Let's turn to defense stocks. Defense ETFs on the ASX up about 55% this year. It's been such a hot thematic. Buy, hold, sell.
I'm going to go a sell on this defense thematic. I think there is a lot of hot air in some of these companies. That's not to say that the companies haven't been performing well. It's just that at some point I think the rubber's going to have to hit the road, in that these contracts that have been supposedly signed have to start to generate revenue and cash flow to justify these very lofty valuations. In fact, it's not only the contracts that have been signed, it's that they have to keep replenishing the well and winning more and more contracts to justify these prices. So I'm going to go a sell on the broader space. In terms of an individual defense exposed name that I quite like, it's Duratec. DUR is the code. Basically, they have a number of contracts across defense, across engineering, industrial space, but they're doing a lot of work in the defense space these days, maintaining ports and repairing ports, and those kind of things. So that's something to keep an eye on if you do want to have some exposure to that space.
Okay, so Michael's feeling quite selective on defense.
Yeah.
But surely with your 5% NATO spending uplift, you can keep replenishing those contracts. Buy, hold, sell.
Absolutely, and I think you've got these major countries around the world saying we're going to have to, we spend 2% of our GDP, we're going to have to spend 5%, or those kinds of things. So there is that tailwind that is going to continue. I do agree with Michael, though, that has to happen somehow, that money needs to start, the contracts need to start flowing through to doing that. So I'm going to stay with my buy recommendation on the defence side of things. My ETF that I like is DFND. It's a Van Eck defence one. It's got a lot of exposure to Europe, and I think Europe is going to be a key for defence spending going forward, especially with what's going on with Russia, Ukraine, and the troops starting to line up other borders. I think that is going to be needed, and I'm happy to stay on a buy for the defence stocks.
Okay, our next ETF is also a supposed hedge against geopolitical volatility, or theme, excuse me. Gold miners. Now, gold mining ETFs have done about 102% on the ASX this year.
Yeah.
Buy, hold, sell.
So we're obviously very bullish on gold, and I like the commodity and just the commodity versus the individual companies. I'm going to say it's a hold because I prefer the commodity, But if you are going to look for global gold exposure, GDX, I think, is the stock code, which is the global miners, and it's Van Eck one again, but it is all of the global miners put together, which gives you the diversification. So you're getting the Newmonts, you're getting all the big guy Barrick and all those kinds of things in there, which is exactly what you need. So yeah, it's a hold, but my preferred one is GDX.
Michael, Adam's going to let the golden bull run. Are you? Buy, hold, sell?
Yes, I'm going to go buy. I do think the producers, the gold producers, can really outperform the underlying gold price this year. Historically, it's pretty interesting that often it takes a number of years after the underlying gold price peaks for the producers to reach their share price peak. Often the market doubts whether the rivers of gold are going to actually flow through to the coffers of these companies, and over time, eventually, the market catches up with the gold price being so high and the profits that start to come through. So GDX is a decent exposure, but broadly speaking, we like the gold producer space. Generally, we'd have a buy on it.
Okay. Staying with you, Michael, Bitcoin. Now, it hasn't done that well this year, but it did do well at some point, and it's still up, I think, about 400% over the past 5 years. It has delivered strong returns. Buy, hold, sell.
I'm going to go a hold on Bitcoin. I must admit it's not an area that I'm overly familiar with, but if you are looking to get exposure to cryptocurrencies, I think the safest bet is to play the behemoth in the room, and that being Bitcoin. So if you want to have some exposure, Bitcoin is the play. So I'm going to go a hold at the moment. I don't really understand why there's been so much pressure on the Bitcoin price. So I would probably prefer gold exposure, but I can see it having a place in the portfolio potentially as a diversification.
Well, mate, if anyone can understand it, I will give them a medal. Because I don't.
No,
Adam, buy, hold, sell.
I echo a lot of Michael, what he's saying. It is an asset class, and I think now, more than ever, it is an asset class, whereas a couple of years ago, they were like, no, it's fledgling and things like that. So this is actually now sitting up. There are a lot of institutions, governments, and all those kinds of things that own Bitcoin. For me, it's a hold also. I just don't know where it's going. It is volatile, but any new industry, it is always going to be volatile. So you just have to buckle up and go for the ride, as it were. So a good ETF that I use is VBTC, and that's a Van Eck one again, but it is more correlated to the Bitcoin price than any of the other ones. So it's a hold from me.
Okay, so let's also turn to another very popular risk asset, well, the most popular risk asset. It is the Nasdaq 100, the representation and the epitome of tech stocks. Buy, hold, sell.
With the Magnificent Seven owning, or what was it, 60% of revenue is pretty much what's doing all of the heavy lifting. I think we've got to be a little bit careful this year, next year coming up. I saw a figure the other day in 1960, AT&T was 13% of the index or the American market, right? So and then we all know how that all ended. So I just feel that we've got too much concentration in there. Nasdaq I'm very comfortable with, so it's a hold from me. I think that it will continue to move. But as Michael said, we need to get these other stocks, the other 100, the other in the S&P, the other 493, to actually do something, and that will then provide the impetus for markets to continue to move. So it's still a hold for me on the Nasdaq.
Okay, so feel the same way, Michael?
Yeah, it's a hold for the Nasdaq. It's had an incredible run. He'll likely have a decent year again next year, but based on all probability. But I do think that the risks are starting to increase. Because these companies need to continue delivering to justify, the expectations. In saying that, I think the Magnificent Seven have, started to diverge somewhat in that they're not all very expensive. So that is something to consider, and they're not all exposed to exactly the same thematics. So there is a chance, and we started to see this play out this year, where some of the Mag 7 perform really well, while others get left behind, and vice versa. So. Yeah, we're still optimistic for the outlook for the Nasdaq, but would have a hold on it unless we get that broad-based breadth in the market. I don't see it roaring ahead.
Okay, and Australian small caps, buy, hold, sell.
Going a buy. Australian small caps is very, very broad though, and a lot of interesting exposures and mining exposures. So our preferred way of playing it is, and it's one of these nuances within the Australian market, there are a lot of active managers that focus on the small cap Aussie market have actually managed to outperform their benchmark consistently over 3, 5, 10 years. So this is an area of the market that we do like. We think there's a lot of opportunity. It's relatively cheap, but I think you need to be pretty active in your selections within this space.
Okay. Michael's completely right. It is a very selective area to play in.
Yeah.
Now, the small orders itself up 20% this year compared to, I think, about 8 to 10 for the broader market buy, hold, sell.
Finally, the smalls are starting to move, right? And, generally in markets, the large caps move, then there's no value there, so then they go to the mid caps, and then there's no value there. Then the small caps start to run. So finally, we're getting some of that small cap exposure starting to move. So yeah, it's a buy from me as well. I think you want to have a manager in there, that's someone that knows what they're doing. Yes, small cap managers might have 10 stocks, 7 of them are going to fail, 1's going to break even, and then 2 are going to absolutely kill it, right? So you can't do that by yourself. You need to have somebody in there or a manager in there to do that for you. And I think that's the proper way to do it. Instead of just trying to pick these small caps and then waking up the next day and it's down 50%, you're like, what the hell happened? I think you need to have a manager or somebody in there to look at those for you.
Now, Adam and Michael have agreed to reveal their top investment theme and the ETF or investment to play it. Adam, what is your top investment theme for 2026?
I was hoping Michael would go first, so then no, it's all good. All right, so for me is copper. I think we've talked about it all this year, how amazing copper is going to be. I think it has still got a long way to run, and I still feel that copper, certainly in the Australian market, is going to do very, very well as globally. The shortfall is always there. For me, the ETF that covers that is Wire, W-I-R-E, and that has all of the global copper miners in there. It has the Australian guys in there as well, and it's a great diversification tool. It's done very well also, but I think Wire is one of those ones that, for the copper thematic for 2026, will do very well.
Okay. Michael, I'm glad I asked Adam first, because it is down to the wire with you.
Hey.
So the theme that we think will have a decent run next year is Australian quality growth. So we've seen a mini bear market of sorts playing out in a hidden pocket of the market, if you like, where a lot of very high quality, classic compounders type businesses have been pulling back 10, 15, 30% in some cases. And you can include, names like Technology One, Xero, Pro Medicus, even things like ResMed, and there's a plethora of names, realestate.com, car sales that have pulled back a long, long way. And it has really not a great deal to do with the underlying performance or fundamentals of those businesses. There's just been a revaluation of sorts. And as the market tends to do, it gets overly excited on the upside, but overly pessimistic on the downside. And we think that a bit of the rotation that's been playing out has gone too far one way. So we wouldn't be surprised if next year replicates similar to what we saw in 2016 and 2017, where these names, although they've sold off significantly, they're still ultra high quality, still growing well and truly above the market rates, and you'll start to see some flows come back into those names. So that is the area of the market that we like, and the ETF that will capture that theme pretty well is the ATEC ETF, ATEC.
Okay. Well, every Christmas tree has a few stars, and hopefully this episode of Buy, Hold, Sell helped you identify which ones will keep shining in 2026. Michael, Adam, thank you so much for your time.
Thanks for having me.
I hope you enjoyed this episode. Please don't forget to like this video and follow our new Instagram channel at Buy, Hold, Sell Podcast. From all of us here at Livewire and our friends from the financial services industry, we wish you a Merry Christmas and Happy New Year.